Good day, I'm Celeste de Haas from Remax Midlands, and today's daunting topic, capital gains tax. The effective rate payable on a capital gain is determined by the income tax bracket in which you fall. It can range from 0% for individuals under the tax threshold up to 18% for those individuals whose income exceeds 1.5 million rand. The formula is as follows: 40% of the gain times 45% of the marginal tax rate. How is capital gains tax determined? Well, it is based on the difference between the proceeds and the base costs of a property. What are base costs? Base costs are those costs involved with obtaining the property, such as your purchase price, your transfer duty, and your legal fees. The other cost is cost of improvements, but excludes general maintenance, and also the selling costs involved, either advertising fees or estate agent's commission. Only the gain from 1 October 2001 is payable. Properties obtained prior to that, the gain up until that date is exempt. From 1 October 2001, the market value or a time-based formula will determine the capital gain on the property. Certain exclusions in the Income Tax Act provide some relief for individuals selling their primary residence as a natural person. When a property is sold for 2 million rand or less, the capital gain or loss is completely excluded. When a property is sold for 2 million rand or more, up to 2 million rand is excluded from the tax gain, since it is your primary residence. When a property is held jointly, such as the case of a married couple, the exclusions and capital gain is shared equally between these two parties. We are going to share an example with you. Mr. and Mrs. Smith. Their base price for the property is 3 million rand. They sell it for 5.5 million rand. The gain is 2.5 million rand, minus the 2 million rand exclusion for their primary residence, which gives a net gain of 500,000 rand. This needs to be shared equally, so we divide it by 2, which gives us 250,000 rand each. Annually, there's a capital gains tax exclusion of 40,000 rand. We deduct that off the 250, so each of them will pay 210,000 rand towards capital gains. To work out the taxable income on that, we take 40% times 210,000 rand, gives us 84,000 rand each that they need to add to their income tax as an income. If Mr. Smith falls into the 26% tax bracket, he will pay, listen carefully now, 21,840 rand capital gains tax. If Mrs. Smith falls into the bracket of 41%, she will pay, listen carefully, 34,440 rand. That brings the capital gains tax to 1% of their total selling price, which is not that bad after all. So subscribe to our channel, give us a call, pop us a mail or a message. We would love to hear from you. I am Dynamite de Haas.